We are now going to cover what I consider the most important part of the chapter. In fact, it's one of the most important parts of this class, I feel. So it's right up there with being able to understand financial statements. If you're a business person, not necessarily going into accounting, you need to understand financial statements. And similarly, the bank reconciliation is something that everybody in business should be able to understand how to do. Not only in business, but you can use this skill in your personal life as well. So, what we are covering is the bank reconciliation. At the end of the month, you get a statement from the bank. You take a look at that, and the cash that the bank says you have does not match what your books and records say you have. So, which one is right? Probably neither. Neither of them actually show how much cash you have. Now, there are various reasons for this, and we're going to go through each of the reasons that it could be and how we reconcile or make sure that they match. What is the real number? What is the actual cash that we have? All right, let's take a look at Carissa's records over here. So these are her book records right there. That's what she says, all right, this is how much money I have that I took in from my sales, most likely right there. And these are the checks that I wrote during the month. Now, these numbers might not match the bank statement. Let's take a look at why. One of the things that could be different is what's called a deposit in transit. And that would most likely be happening at the end of the month with this one. So Carissa, at the end of the day on May 31st, took $1,870 to the bank. And most likely at that point, the bank was closed. So what does she do with it? She puts it into the night deposit box, the after hours deposit box. Every bank has one. You just put it, seal it up in an envelope and shove it in the little slot. And then the bank, when they open the next day, they look in their night deposit box and hey, there's all of the stuff that goes in. So why is that not on the bank statement? Well, notice that, yeah, that one's missing. There's nothing over here for $1,870 on May 31st. Well, that's because this is a bank statement for May. When did the bank get it? That was in June. They got it June 1st. So as far as the bank employees know, this came in on June 1st. But Carissa says, no, I dropped it off at the bank on May 31st. So Carissa made the entry on May 31st. The bank makes it on June 1st. So on June's bank statement, we should see the $1,870 come through. But it's missing on May's. So that's going to be one of the differences that we will see on these bank statements. All right, and that's called a deposit in transit. All right. Also on the book side here, we're going to look at all of our checks. We wrote a lot of checks. And to understand what is happening here, we have to understand the process that a check goes through. So let's say you write a check to your friend. And to get the money from that check, what does your friend have to do? Your friend goes to the bank. And this is their bank, right? Not your bank. Now, they give the check to their bank. What does their bank do with it? Well, they probably immediately give the money back to them. So let's say you wrote a $100 check. So their bank gives them immediately $100. Now, where does that $100 come from? Well, temporarily, the bank has used their own funds to give the $100 to your friend. Of course, they want to be reimbursed from your bank. So they now send this check over to your bank. And your bank says, oh, yes, we know whose money that is. The check has some numbers on it, routing number, and an account number on it that says, hey, this is supposed to come out of your account. So your bank takes the $100 out of your account and sends it over back to your friend's bank to reimburse them. All right, so this process takes time. And we have to understand why that this process takes time for a couple of different things that we're going to talk about. And the first is outstanding checks. This whole process takes time, so right immediately we say, we wrote this check, we write it in our books. We make a journal entry, say, we wrote an $850 check. Or in this case, we wrote a $100 check to our friend. And we immediately write that down. We make the journal entry, say, we spent $100. That might not show up on our bank statement for quite some time because our bank does not know about that until the process is complete. Now, it might take a while for your friend to take this check to the bank. It could take months. And then you write your friend, say, hey, we wrote this check. It's still not showing up on my bank statement. Your friend says, oh yeah, I forgot. Sorry, I'll take it now. So in the meantime, we know we've written a check, but our bank does not. So it does not show up on the bank statement until our friend takes it to their bank. And then their bank sends it to our bank. And our bank then finally knows about it, takes the money out of our account. It's only then that it will show up on the bank statement in the checks written part. So this can take some time. The most time is usually taken up in our friend remembering to take the check to the bank. That's usually the most time. The process of their bank sending it to our bank and reimbursing, that can be done nowadays pretty quickly. So it could be a couple of days. Still takes time, right? So it could take a couple of days. But most of the time is usually having the person remember to take it to the bank. So in the meantime, though, we have a check on our books that is not showing up on the bank statement. These are called outstanding checks. Outstanding checks are checks we have written that we know about that we are waiting for someone to cash them. So our bank doesn't know about it. And we can see here in this example, there might be like check 1420. And you say, all right, we wrote check 1420. I don't see it over here. It's missing because someone hasn't cashed it yet or it has not gone through this entire process. All right, so those are the main differences when we're looking at things that aren't on the bank statement that we think should be. So the two main things are deposits in transit and outstanding checks. Again, so those are things that are missing on the bank statement. Let's look at it the other direction now. There are a lot of things on the bank statement that we didn't know about. And what are some of those things? We might have, for example, automatic payments for our rent coming out. And we don't make the journal entry because we don't know exactly when it's coming out. We might not know exactly how much it was until we actually look at the bank statement and see, oh, well, hey, there's this EFT, which means electronic funds transfer, for $400. I don't have that over here. So I would say, all right, well, I have another $400 coming out that I didn't know about. So that's something that we might not know about that is on our bank statement. Another thing might be deposits. Maybe someone is paying us electronically. The things over here on our side in our books, so this is our cash ledger. These are only things that we probably got cash for or checks, and we're taking them to the bank, so we actually handled them and said, all right, I know this is going into the bank account. This electronic stuff, we don't know about it until we actually look at the bank statement. So these EFTs can go both ways. It's either we spent something, so we, purchases, or it could be sales or other revenues coming from our customers that we didn't know about until we looked at the bank statement. All right, another thing that might be on our bank statement is a service charge. So if we didn't write a check, then we don't know about it until we get the bank statement. So we now say, oh, I see that I have service charges on there. Again, that's something that I didn't know about that I need to put on my list of payments that I didn't have. All right, and we also might have interest on a checking account. That would be a deposit. I don't see it on this one. I don't see any interest, but for example, you might have $10 in interest. That would show up on the bank statement, and we didn't know about it until we get the bank statement. We have no idea exactly how much it is until the bank tells us. So I'm going to put that on the list here of stuff that we need to look for. Interest. All right, and another thing that we might look for is not sufficient funds checks and bank collections. All right, let's look at this bank collection. I have never seen this in real life, but it shows up in every single accounting homework problem I've ever done on bank reconciliations. I don't know authors' fixation on these note collections. So this is a situation where we are collecting money from a customer. And maybe the customer was late, or maybe they set up terms with us and we said, sure, but can you just do it through our bank? And so we set this collection up with our bank, and so our customer pays the bank directly, and then the bank puts it into our account. So we're not handling the check itself. We're not handling this note. They just deal with the bank instead of with us. And so that's what this one is right here, means bank collection. And so the $1,700, our other notes here said that's for a note receivable. So again, we didn't know that our customer had paid us the $1,700 because they didn't pay us directly, they paid our bank. And so we don't know about it until we get the bank statement and say, oh, hey, look, they paid us. All right, last one, and this is probably the most difficult one for us to understand, at least in my experience for students to understand, is the not sufficient funds check. And we have to go back down here to our check situation here. So let's say we are, we're going to change it up our scenario to, this is us right now. And we were written a $100 check. So we got a $100 check from our customer. And we take this $100 check to our bank, and our bank gives us $100. Again, remember our bank wants to be reimbursed. So they just gave us the $100, assuming that the customer had $100 in their bank account. So our bank takes our customer's check, sends it to their bank. So this is our customer's bank right now. And the customer's bank says, there's not $100 in the account. So we can't give you $100 because the customer doesn't have it. So the customer's bank sends back to our bank, says, sorry, we can't give you $100. Our bank says, well, I shouldn't have given them that $100. So what are they going to do? They're going to subtract the $100 from our bank account. All right, from us. So basically, they gave us the $100 and then they took the $100 away. So it's a net zero for us because essentially we never got paid. We thought we had been paid. We never actually got paid. So we had written that probably in our cash receipts, somewhere in here, that we were paid. In this case, it looks like $700. We were paid $700. Let's say it was in this May 4th one. That included a $700 check from one of our customers. And our bank sent out all of those checks and got paid, except for that one $700 check. So the bank subtracts the $700 from our account. Again, this is a net zero. They gave us the $700, then they took it away. Except on our books, we had written, we have $700. We find out when we get the bank statement, hey, that's not true. So we need to subtract $700 from our books because we found out, hey, we never actually got the $700. Now, what are we going to do in this situation? First thing that we're going to do is probably go back to our customer and say, hey, you owe us money. So keep that in mind when we're doing journal entries that our customer owes us money. But for our books and records, we basically have to reverse this out saying we never got paid. All right, so I think that is all of the basics. Oh, there's another situation. So I'll keep adding here. We have collections. Now, this is called a not sufficient funds check, but more colloquially, it is known as a bounced check. So when our customer's check bounces, we get money subtracted from our bank account because our bank says, yeah, I'm sorry, the money's just not there. All right. The last thing, which can go either way, is someone makes a mistake. There is an error. And we're going to see an error in this situation where someone made a mistake writing down the numbers. Now, this could be us making the mistake, writing down the numbers, or it could be the bank making the mistake. Most often, it's us making the mistake. So we'll see what we do with errors, whether it's the bank's mistake or our mistake. I almost always assume that it's our fault, not the bank's fault. But when you find that something is different, like one of these numbers was different, let's say 4150 and 4150, let's say the bank had a different number than us, well, we probably made the error, not the bank, but we have to go back and check all of our records anyway, just to make sure it wasn't the bank making the mistake. All right, let's erase all of this and actually do a problem. So I'm going to break this video up into two parts. This first part was explaining why the records are, why our records are different from the bank statement. And now we're going to run through a scenario in the next video about how do we come up with the real cash number and how do we make the journal entries to fix everything.